Let's set the scene. I want you to imagine a sleek, glass conference table way up on the 27th floor of a high-rise in Dallas. Two guys wearing pretty standard, plain suits are sitting across from a whole room packed with top-tier executives.
These executives represent a massive empire. We're talking 9,000 physical stores.
60,000 employees on their payroll.
And they are pulling in a staggering $6 billion a year in revenue.
And in just a few minutes, the man running this entire empire is going to try really hard not to laugh right in the faces of these two guys who are about to ask him for $50 million.
Now, here's the big question, right? It's a question this one specific meeting forces onto anyone who's ever had to evaluate a competitor. How do you actually tell the difference between a company that is an absolute joke and a company that's just early? Because honestly, from where Blockbuster was sitting back in 2000, those two things look completely identical. Think about it. On one side, you have $6 billion in revenue walking through the front door every single year. On the other side, a tiny startup with maybe 300,000 subscribers, and they are just bleeding cash. On paper, there was absolutely no decision to make. And you know what? That is exactly what should worry you about this whole story.
So, let's rewind a bit. 3 years earlier, these two guys, Reed Hastings and Marc Randolph, had started this little company renting DVDs by mail. Their whole hook, no due dates, no late fees. It was basically a direct, almost personal response to the exact kind of annoying late fee that had famously ticked off Hastings at a Blockbuster counter.
But by the year 2000, Netflix wasn't exactly proving much, at least not financially. They had under 300,000 subscribers. They were losing money every single month. In fact, they were on pace to lose around $50 million that year alone. Plus, the broader market was definitely not helping. The infamous dot-com bubble was collapsing in real time, right before their eyes. And the venture capital that used to just flow toward exactly this kind of tech company, yeah, that had mostly dried up. Hastings desperately needed a way out, or, a way through. So he did what founders in that tight spot usually do. He went looking for a much bigger company to either buy him out or fund him.
And Blockbuster? Well, they were the obvious call. They had those 9,000 stores. Their name was plastered in nearly every strip mall across America. And their chairman, John Antioco, had a solid reputation as a really sharp operator. So Hastings, Randolph, and Netflix's CFO, Barry McCarthy, actually chartered a small plane at 5 in the morning just to make this meeting in Dallas. Once they finally sat down at that glass table, the pitch was incredibly simple. It was basically a three-part plan. Blockbuster buys Netflix, Netflix takes over the online side of the business for them, and Blockbuster just keeps doing exactly what it already does so well, running the physical stores.
So Antioco listened. And according to Hastings' own account later on, Antioco nodded along, he asked good, probing questions. He actually seemed genuinely engaged for a few minutes. But then, he finally asked for the number. The asking price, $50 million.
Now, according to both Hastings and Randolph, that is the exact moment the entire temperature of the room just changed. Randolph would later describe watching Antioco's mouth physically twitch, like he was actively holding back a laugh. McCarthy, the CFO, who is also sitting right there, later recalled how the offer must have landed. It probably sounded completely absurd to the Blockbuster side. I mean, think of it from their perspective. Here is a company actively burning cash, operating on the absolute fringe of an industry Blockbuster already totally dominated, and they are asking to be bought for a number that wouldn't even move the needle on Blockbuster's massive $6 billion balance sheet.
But wait, it is absolutely crucial we pause here and realize why Antioco's read on the situation wasn't actually stupid. Blockbuster was not wrong about the numbers sitting right in front of them. Netflix's subscriber base really was small. Their financial losses were very real. And remember, back in 2000, broadband internet was still so rare that digital streaming wasn't a near-term threat to literally anyone. So DVDs by mail was the entire Netflix business, and to an outsider, it just looked like a weird little niche. From inside a $6 billion corporate giant, spending $50 million for a money-losing mail-order DVD service, that is not an obviously good use of capital. And that right there, that's the trap in this whole story. This isn't a story about a stupid executive making a stupid decision. It is actually a story about making a completely correct read of the wrong data.
See, what Antioco was actually pricing in his head was just Netflix's current subscriber count. But what he should have been pricing was Netflix's model. They had built a direct relationship with the customer. They had entirely eliminated late fees. They were pushing a subscription model instead of a one-off per rental transaction. And they had a founder who had already gone on record saying he was totally willing to lose money for years just to build that base. But here's the thing. None of that hidden value shows up as a neat little line item you can put into a spreadsheet in the year 2000. No, that kind of value shows up as a massive, existential threat 5 to 10 years later. And by the time it does, well, it certainly isn't a $50 million problem to solve anymore.
Sure enough, Blockbuster eventually went ahead and built their very own version of exactly what they had turned down that day. They launched Blockbuster.com, and eventually they even rolled out their own subscription mail service. But they did it years after Netflix had already locked in those customer relationships, mastered the complex mail logistics, and completely cemented their brand association with the whole idea. By the time Blockbuster finally took the threat seriously enough to copy it, they were just copying an established competitor instead of outright owning the entire category for what would have been a measly $50 million.
Back in that Dallas boardroom, though, Antioco heard the $50 million price tag and just declined right on the spot. In Randolph's account of the meeting, which he published years later in his memoir, he says Antioco entirely dismissed the broader internet trend that Netflix represented. He apparently told them, quote, "The dot-com hysteria is completely overblown."
Now, we definitely need to be precise here, because this is the exact part where the story usually gets flattened into a simple meme-like punchline. John Antioco himself has actively pushed back on the specific version of events. He stated publicly that he doesn't even recall any serious acquisition talks taking place at all, and he highly disputes the dramatic framing that's been built up around this meeting over the years. But here's what isn't disputed by either side. Netflix came to Blockbuster that day, they pitched a specific number, and they walked out without a deal. Whatever the actual tone in the room was, the outcome is exactly the same either way. And that undisputed outcome is the entire reason we are still talking about this specific meeting over 20 years later.
So what happened next? Well, Netflix went public 2 years later, in 2002. And truth be told, they actually kept losing money on and off for years after that. This wasn't some kind of instant magical vindication where they immediately became profitable. Hastings himself has admitted as much. But what Netflix had that Blockbuster completely failed to register in that meeting was a business model built fundamentally around a customer relationship rather than a physical store visit. So when broadband finally became fast and common enough, Netflix just pointed that exact same subscription relationship directly at digital streaming. And they did it years ahead of anyone else who was positioned to compete with them.
Blockbuster, meanwhile, they spent the entire 2000s desperately trying to manage a massive, store-based business that was suddenly under intense pressure from practically every direction. You had Redbox kiosk rentals completely undercutting them on price, you had Netflix entirely undercutting them on convenience, and on top of all that, Blockbuster's own late fee revenue, which used to be a huge asset for them, rapidly turned into a toxic liability that customers absolutely hated. Ultimately, the pressure was too much, and Blockbuster filed for bankruptcy in 2010.
Fast forward a bit, and by the time business reporters went back to ask everyone about that infamous $50 million meeting, Netflix's value had utterly skyrocketed into the hundreds of billions of dollars. That $50 million asking price, the number that once looked way too high for Blockbuster to even take seriously, in hindsight, it had become almost absurdly, hilariously low.
But again, treating this as just a simple story about one dumb executive making a dumb decision, that is exactly how you miss what this piece of history is really trying to teach us. The true lesson here is this. The threats that eventually end your business, they rarely show up at your door already looking dangerous. No, they show up looking small. They look underfunded. And most dangerously, they look incredibly easy to dismiss using the traditional metrics you already trust.
If you only ever evaluate a new competitor by the spreadsheet numbers they have today, you are going to keep making John Antioco's decision. And you will be making it correctly right up until the exact year it becomes catastrophically wrong. The businesses that are actually worth taking seriously are usually the ones that are the easiest, on paper at least, to just brush off. That Dallas meeting, that was the meeting that ended Blockbuster, but it sure didn't look like the meeting that ended Blockbuster, at least not for another 10 years. So it really makes you wonder, look at your own spreadsheets today. What perfectly correct decision are you making right now that might just turn out to be catastrophically wrong tomorrow? Something to think about, right? Anyway, that wraps up this explainer.